If the last mile continues on for longer than expected, does that mean the party continues on for longer than expected too, as we wait for that magic first rate cut?
Right. I'm fairly optimistic about the party continuing. And I say that because economic growth is still strong. I mean, the second quarter GDP is running close to 4%. And if you look at the consumption patterns, what determines that is whether you have a job, whether you're getting paid more for the job, and how much you're paying on your mortgage expense. And I know it's quite a bit different in UK, Europe versus the United States, but in the US, 5% of mortgages are floating rate. The rest are fixed. So all of a sudden, you're in a situation as a consumer, you've parked all this money in a money market account, you're getting paid close to 5.5% on that, but the mortgage expense, I think the average mortgage rate is something like 3.5%. So that's actually a very favorable backdrop for consumption, and I think that's why we've been surprised over and over again that the U.S. economy is so resilient.
Only for some, though. I mean, this whole Goldilocks notion suggests that everybody wins and it's a great fairy tale, but there's only really one winner at one point, which was Goldilocks. But the too hot, the too cold, if you look at the consumer patterns, the economy is not right for some consumers, already changing their behaviours. And we're seeing at the low end in particular, that's well and truly sight, and McDonald's saying this the other week. At the high end, some of the luxury players are saying they're seeing it too. So it feels like some of this not too hot, not too cold is actually falling a little bit cold for some of the consumers.
I think there's been some pushback on the level of pricing, and I think you're right that we're seeing that across all the income cohorts because, once you've raised prices, 5, 6, 7% for a number of quarters and years, you get to a level where consumers, maybe more from the sentiment level, are starting to push back. But what I am encouraged by in the U.S. is this broadening out of the income level growth. And what I mean by that, you look in 2022, the low income consumer really suffered because of higher inflation, and they were not benefiting from, that higher interest rate that they were getting on money markets. That was the top consumer. But that is broadening out, and now all cohorts are actually seeing their wages go up in real terms and their disposable income go up as well.
Do you think the market gets that? Because if you look at the positioning around tech again, to me, there's an element of fear in the sense that we're not that confident that the growth is going to continue for the consumer. We're not confident about the breadth coming back into the markets, even though there's been a little bit of it. We'd rather keep on going with more reliable trades here. We know there's still growth from the tech story because of AI. So even though the multiples are fairly challenging, let's just keep going that direction because the growth story there looks firmer than the growth story across the rest of the economy.
I mean, tech is so hard to avoid because it is a perfect combination of the cyclical upside, but also the secular upside, which of course you alluded to. So everybody knows the AI story. That's why they're there. But the reason why I think tech is also participating is if you are betting that the manufacturing momentum is picking up around the world, if you're betting the consumption of computers and mobile phones is picking up, you're going to bet on some of the most cyclical parts of tech, and that is semiconductors. So I think that's why people have conviction there. But I will say, if you look across the markets, we've seen tangible signs of broadening out. For example, it's not just communication services, semiconductors. Well, of course, they're leading the pack, but you've also got financials, you've got industrials, all of those sectors actually outperforming the S&P.